What's up, Wealth Nation? Darius and Carmen here, joined with Andrew Stafford, the president of Prevail and our friend and business partner in our insurance business. We are really excited to talk about today's topic, which is about index universal life policies and how it compares to whole life insurance. And the reason why we decided to talk about this topic today is because we get it nonstop in the comments. Carmen and Darius, what about IULs? How do I use IULs with infinite banking? And so we wanted to have a meeting of the minds today to be able to really understand the different products, how they should be used, and allow you to make an informed decision. So without further ado, let's go ahead and introduce Andrew and welcome him to our video.
Well, it's good to be back.
What's up, Andrew?
Well, I'm doing great. Doing great.
Good.
I'm excited to be with the Wealth Nation crew again. It's always good topics that we go over.
Yeah.
Nice. Now, we're going to be discussing IUL. So, Andrew, if you can set us a good foundation before we go into what exactly is an IUL, can you kind of set the foundation as to how we got to this place of index universal life?
So, Darius, I think the key to this is we're going to refer to index universal life as IUL throughout our discussion today. For the audience, I do want to reiterate, it's not that IUL is good or bad, or that whole life is good or bad. They are both tools. And if you go out and you try to think about what tool is applicable for the job that I'm doing, you don't grab the wrong tool. You get what is exactly needed for the job that you're doing. The problem that the industry has is many times we're utilizing the wrong tool. And the wrong tool because it may be easier to sell. It's got illustrations that if you were to put it in front of any one of us, right, we would look at that and be like, and say, I want that. Why would I not want that? And the issue with it is the reason I would not want that goes back to, am I looking for consistency versus volatility? Am I looking for something that I can plan on versus something I hope will happen? And if you were to compare the two, 9 times out of 10, with some variance, a whole life illustration is going to work out pretty darn close to the way that the illustration is shown 20 years from now.
Yeah.
And coming off this low interest rate environment where we've been bouncing off the lows of guarantees in whole life product and lower dividend crediting rates, it doesn't have a lot of room to go down, but it has room to go up, right? Because we're in this lower interest rate environment. In an IUL product, the insurance company has transitioned the responsibility of investment return or gain in your policy, whether it be from in the indexes you're choosing in the IUL versus a dividend crediting rate. They've transitioned that from them to you. They've completely taken the liability of making sure that the illustration works and put it on the consumer.
Mm-hmm.
That's frightening.
Mm-hmm.
Right? And so today I'm going to refer to this, and I did it in the last video. And Carmen, and Darius, you and I've talked. I refer to insurance products as a chassis.
Yes.
Okay. And the chassis is the same on just about everything. For most part, they're providing a death benefit. And inside that death benefit, there is some form of cash accumulation. Whole life does it through a dividend crediting rate. IUL does it through you picking from a select group of investments and trying to hope that it does the return that the illustration says it's going to. But just like a car going down the manufacturing line, the chassis is the same. They changed the top as far as the body and all of the accessories you want in the car. They change it, but the chassis is the same. You want a 2-door, 4-door, electric, gas, it doesn't matter, right? So that's why I call it a chassis. And the IUL versus whole life is on a insurance chassis, but a very different model up top, right? You're getting a very different car that's coming down the assembly line.
Very much so, yeah.
And
I love this. Speaking from a true car guy.
Yeah. And I think that the consumer needs to understand that, because last week when we talked about the whole life product being the Swiss Army knife of insurance products, it can do so many things. I would actually say the IUL is the most complex product that is on the market, that people don't understand the complexity of it.
Mm-hmm.
Yeah.
One thing we focus on our channel is discussing how we can borrow from our life insurance policies. And one thing that I understand with whole life insurance is the fact that when you borrow from that policy, you're still continuing, your policy is continuing to grow, even though you have money borrowed. When it comes to an index universal life, am I able to borrow that money and it still operate in the same environment as if I didn't touch it?
So that's an awesome question. And it's not as easy as saying yes or no.
Yeah.
Okay. And the reason that I will say that is very different than a whole life policy where we've got a very consistent dividend crediting rate and growth in cash value. It depends on how your indexed choices have performed. And in addition to that, there are surrender charges associated with an IUL product that are very long. So what you show as your cash value inside the product may not actually be what you can actually borrow against because the surrender charges that are associated with it. And so in a doomsday scenario, let's take last year, okay? Last year was a good market year, 23. The year before was really bad. If you posted a 0 from the prior year, had no cash value or increase, right? In from 22 because the markets didn't do well. So you're not getting any of the return. So you have a 0 for 22. You're still early in the surrender charge period of the IUL. And then you go choose to pull the cash value out of it. You could in turn lapse your policy.
Yeah. Yeah.
Because the cash value that shows is there isn't actually there because of all of the different contractual intricacies they've put in these IULs. And again, goes to a very complex product.
Yeah.
Can you shed a little more light for the audience on what is a surrender charge for an IUL?
So in IUL, let's start with, okay, and this is important. All products are different, okay? And I'm not stating good or bad. Commission rates to advisors are higher on IUL products generally than they are on whole life products. The whole life commission products have a lower commission rate for advisors. So the only way that the insurance company can make up for that, because there's only 100 pennies in the dollar, right? So if they pay a higher amount out to the advisor, they have to recoup that over time. And so what they do is they put a surrender charge on the policy, meaning I drop 15 grand into an IUL or an annual premium policy. And let's just say, for example, there's $10,000 worth of cash value there showing. You really don't have access to that 10. It might be 2, right? Or it might be 3, because the insurance company is saying, well, we've already paid the advisor. And if you quit this policy or you want to use this policy or you want to take cash value out, the cash isn't there. So they penalize you for a set amount of years on accessibility to the cash that's in the policy, and or if the policy were to lapse or you say I don't want it or whatever the case may be, you don't have access to the full amount of value that is shown in cash in the IUL until the surrender periods end. And they vary from product to product, but they're much longer. Now, on the different side of the whole life policy, while you still have a hit to cash value in year 1, the cash you show is yours, right? You have access to it. Very predictable, very consistent.
Yep. Thank you for answering that, because it again, you brought it to this point, is the intricacies. And that's why I think it's so important for us to just take our time, massage through this and talk about these points, because these are really the nuances that need to be said. Because if you're trying to infinite bank, right? If you're trying to borrow money out of your policy and you're expecting X amount of dollars, and when you go to request that money and X amount of dollars isn't there, that's going to significantly change the trajectory in which you're trying to use your policy for investments. Use your policy to pay off debt, use your policy to do X, Y, Z, if you're banking on the money being there. So that's another thing that we want to make sure that everyone understands, again, these intricacies and how it can apply when you're trying to grow another bucket of wealth.
The other piece, Carmen, that's important is whole life versus IUL. when you have, let's say, some of the limited pay products like a 10-year or a 12-year or a 15-year pay whole life product, even if you pay to 65, whatever the case may be, at some point in time, that product is considered paid in full.
Yes.
And so you have a locked in guaranteed cost of insurance inside the product that is not changing, right? It's amortized out for whatever the time period is. It's called paid up. In the IUL, you don't have the guaranteed rate of cost of insurance. And so in the later years, when you may want to use the cash value, it's not going to show this on the illustration, or it may not, right? I'm not going to say it's not. But the insurance companies can adjust the internal cost of insurance. And so you have a drag late in the policy years as you get older and they still have to insure the death benefit for you. You have a larger drag on the policy because it's never been fully paid up, and they have the ability to adjust the cost of insurance. Now, they're not going to illustrate it going up at a significant rate. They're going to take whatever the table is for your age and they're going to run it out. But again, variability, it can change. It's volatile. It's unpredictable. They have transitioned the risk to you as the consumer versus the insurance company to say, this is a fully paid product at 10, 12, 15 years, whatever it is. And here's the illustration. And there's less drag on the cash value later in years because all of those costs have been pushed up into the front years of that product and it's fully paid up.
Yeah. Yeah. Yeah, and I can speak to this personally because I remember when we first got into the industry, and my mom had she had an IUL policy, and we were just looking at it.
Two of them.
Yeah, she had two of them. We were just looking at it, reviewing her illustration, trying to make sense of it, understand it. And what we saw was that this whole thing was going to implode by the age of 75.
Yep.
And I guess she knew that. And had this in her mind, oh my gosh, what am I going to do with my life insurance policy? Because I only have until 75. So can you think about that? As you're planning for your grandchildren and this and that, it's what am I going to do with this policy? Am I going to outlive this thing? What's going to happen? And so those are the things that we start to see a lot with exactly what you're talking about, is just the cost of insurance and how the cash value is going to either may or may not be there, right? We're not saying this is good or bad, and how that could affect premiums and how that could affect the longevity of you actually maintaining and keeping this policy on the books are all things that you should consider.
And here's two other points. I can't tell you how many times, and it's not going to affect you at 50 or 55, right?
Yeah.
But I can't tell you how many times we have to figure out with clients that come in how to unwind the IUL and 1035 it into something else, because it either is going to lapse or the client has to put more into it, or there's an action required from the client that they did not expect, right? We run into this often. And when you do need, at that point in time, you've accumulated a ton of cash inside of the policy, and we're looking at it saying, yeah, but when you do hit 70, this thing's going to start dropping like a rock. The problem is that 55 or 60, when we go to try to 1035 that into a different policy, your health has changed.
Yes.
Right? You may have gotten the IUL 10 years ago when you were much more healthy, and life happens, right? You go to the doctor and they say you got, high blood pressure, high cholesterol, all these different things that you didn't have the day you got the IUL. And now you try to 1035 it into something that's consistent that you can count on, but it's harder to get rated for it.
Yeah.
Now, I understand when it comes to life insurance with the insurance company, the verbiage that we use is very important. We can't call life insurance an investment. But I find it to be very difficult to sell an IUL policy without using some of those terms that they tell us not to use. Why did the insurance company create IULs in the first place if everything that it stands for, we basically can't sell it that way?
So here's the thing.
See what had happened was.
Okay, this is interesting. If you take the history of the IUL process, let's just call selling the IUL, it's very rare, right, that the insurance industry and the regulatory bodies come back in and have to put caps on what you can actually illustrate. And they've had to do that, right? So there's been, in the last 5-10 years, there's been multiple times they've come in and said, you can't sit down and show somebody an illustration with a 10, 12, 14% annualized rate of return. And so they've tried to cap it, right? The issue, so that should tell you something. Okay, that in and of itself is really all you need to know. When the regulators come in and tell you you can't show something the way you're showing it because it isn't going to work like that, that should be enough said, and we should drop the mic and the video should be over. But that being said, here's the thing that's interesting about your question, Darius. It's a simulated equity style return. Simulated. And we've talked over and over in our discussions. If you need equity exposure, buy the real thing.
Right.
Right? Don't simulate it. There's nothing in my life that I like simulated. Right? I want the real deal. And so that's what ultimately happens is they call it a simulated return. Now, here's another thing that's critical. We look at return in the markets in calendar years. Okay? And so you think of 2022, the markets were down. 2023, the markets came back up. And that's how our mind thinks. So if somebody asked you, how did your IUL policy perform, in 2022 when the markets were down? You look at it and say, well, I'm not sure. How did they perform in 2023? Well, logically, you would think, well, I should have gotten some return. Okay? I should have gotten some return. And the thing that people don't understand is for most products, not all, you need to understand your individual intricacies of your products. They operate on a point-to-point system. And what point-to-point means, if I buy my product in May of 22, my point-to-point period of where I'm doing my calculation on return is May of 23. Let's take even a worse time. The worst months, right? The worst months last year, even we had an up market. August, September, and October, terrible time in the market. The market pulled way down. If I was in the point-to-point system for that particular year, I'd bought it in August, September, October of the year prior. There's no return, even though the market went up 20-some%. I want to share something with you that is real data that has been shared, with us. And again, not that IUL is good or bad, just use the right product. So let me see if Carmen, I'm not very technical, so let's try this here.
You are fine, Andrew. Go ahead.
All right. So this is the S&P 500, right? Just looking into the S&P 500 index for the past year, okay? And we're in January, so this is pretty close. Up here where it shows past year, it's saying during this time frame, the S&P 500 was up 21.46%, okay? Now, let me show you something. These are the individual returns by carrier for IUL product. Let's look at the last 12 months, same time frame. So this is the end of year 12. Last 12 months, we just looked at the market was up 21+%.
Yeah.
Let's pick some. Okay, so you come down, you look at Lincoln Financial, their BlackRock Dynamic Allocation Index. This one right here.
Yep.
You see it?
Yep. Sounds real dynamic.
Come over to the 12-month return, -1.92. Okay, let's go down. Let's look at Pacific Life. Big
or even
company.
24 months out. Wow.
Yeah, Pacific Life, great company. Let's come down. 24-month return. I'm about 3/4 of the way, or 12-month return, about 3/4 of the way down the page.
Yeah, we see it.
-2.48. Okay. The market was up 21%.
Yeah.
Tell me how this is happening, right? Now let's take a 24-month period. We'll spread it out, Andrew. We can't look at anything in a year's time frame. 24-month period. Do you see very many positives on here? I don't care. Pick which one you want. They're negatives, right? Then we go to 5 years. 5 most recent years. You know what the market has done in 5 years? 5 years. And still, let's just take the top. AB All Market Index, 5 years, -0.42%. You come down. Now, there's some big ones on here, but here's the thing you also have to understand is sequence of return.
Thank you. Speak on it.
Okay. And we've talked about sequence of return. So let's go to what that means. Sequence of return, you drop $100,000 into a product, right? Just call it investment, call it IU. I don't care what it is. You drop $100,000 into it. Both of these scenarios averaged a 4% rate of return. But the sequence of the return and how it happens is critical.
Yep.
So on the other side, on this right side that's in green, we start out with a couple of negatives. Now, in the IUL, let's just say they're zeros, okay? They're just zeros. So you come out and you have a couple of bad years. Now, we just looked at that chart that said for the last two, there's a lot of negatives on that chart. So let's just assume they're zeros. That same average rate of return is $70,000 less in total value than the blue return on the left. So the blue return had 105, right?
Mm-hmm.
The green return has 35.
35.
Now, this is also associating that there's an annual withdrawal inside of here.
Oh, perfect.
Okay. So there's a $5,000 annual withdrawal. So that impacts your sequence of return even more. But still, if you're going to have a product, you're using it.
Mm-hmm.
You're either going to pull income from it, you're going to pull money out of it. And in your guys' world, you may cycle it to buy something. So I don't want to go down the argument that says, well, don't talk about a withdrawal. Well, then why do you have it? Right? We have these to use. There's going to be some form of withdrawal. So the sequence of return matters. And in IUL,
so glad.
you can't predict what the returns are going to be.
No.
And if we go back to this, last 24 months, there's a lot of negatives on here. Last 12 months, there's a lot of negatives on. You even go to the 5-year return and say, okay, well, maybe it averaged 7, 5, 6, 8, 10%. But the sequence of return inside of that matters, because if I started that out with a couple of zeros, right, my overall accumulation at the end, even though I averaged the 5, 6, 7, 8, 9, 10%, is not the same as if I would have just consistently clicked off a lower rate of return, but done it every year. So 3 things to take away from this. You have to ask yourself, 12-month period, the market was up, okay? We're looking at the carrier return rates on their indexes inside some of the policies, same period. There's not a lot of policies on here. You go out 24 months, not a lot of policies on here. And it goes back to the concept of what we talked about. Point to point, okay? When you get it, the investment return is on you. You have to be willing to go in and manage it as an investment advisor. So you have to either have an advisor who's engaged with you significantly or be astute enough to be able to go in and pick the right index. Are you sure you can pick the right index? Not sure I can, and I'm in the business.
It's so much. So hold on one second, Andrew. There's so much that was just revealed right now. So one, I want to thank you so much for sharing all the numbers on your screen, because I think this is also the differentiator in just having a conversation and also just applying logic and seeing the numbers to it. Because what we always say for us, our personal policies for the Darius and Carmen, for our family, we're always looking at this particular product, whole life insurance. We want guarantees with this because we have other things going on. We're business owners. We have exposure in the market and things of that nature that have risks, right, associated with it. And so for us to have a whole life insurance policy, we want something that's going to provide us guarantees because we have some stuff spread out and other opportunities. And the other thing that we were talking about, which is Darius alluded to, like, why was this product even created in the first place? Well, the insurance companies needed to compete with the stock market, right? Everyone was pulling out and saying, let's go invest in the stock market. And the insurance company said, wait, hold on a second. We have a product that can simulate, to your point, right, the same returns. And then that goes about having a conversation of average rate of return versus the actual rate of return, right? Because that's another conversation where this can get, where there can be a huge misunderstanding where people can say, oh, my average rate of return was 4%. Right? But what was the actual rate of return, which is actually what you showed us on the screen today. So again, thank you for sharing that. And it just continues to beg the conversation of, if I see these particular returns, now I have to be involved with this policy and to be able to pick the right equities that are going to profit for me. How is that going to affect the cash value? How is that going to affect my cost of insurance in the future? And how is that also going to guarantee that I can pass a death benefit should something happen to me? So these are all of these things, anomalies, why Darius and I we just don't want to deal with it as agents ourselves because of all of the intricacies. And for us, it doesn't make sense for our business. Like I said, not saying that this is right or wrong. For some people, it makes a lot of sense, but just everything that you revealed is the reason why we don't sell IULs in the first place. But that's just our personal experience.
Now, with a person that's
let's get real with this, okay?
Let's do it. Sleeves
it's
up.
easier to sell.
What do you mean by that, Andrew? What do you mean?
I was
If you
just
can
getting
sit down and go back to the beginning of what we talked about, if you can sit down and illustrate something that has a strong likelihood of not turning out the way that it's going to turn out, but it looks really good, right? It's easier for advisors to sell it because we as consumers are like, I want that. So think about you see a commercial. I'm just going to use Hardee's. You might not even have Hardee's across country. You ever seen a Hardee's burger drop on a commercial and it's huge and it looks awesome and you're like, yeah, I don't eat at Hardee's very often, but God, that burger looks good. And then you go order the same burger and it comes out and you're like, that's not what was on the commercial. What happened?
Oh, man.
Right? It's like, okay. And I'm really hungry, so I'm gonna gobble this down. It's the same thing, right? You illustrate or you put a commercial out there or you do something with these products that is simulated. Whole life products are consistent, they're boring, they're not meant to compete with the stock market, but you can, for the most part, you can have a pretty high assurance. Specifically, if you look at the illustration at the guaranteed crediting rate, which are the floors on them, you know, okay, this is how it's going to turn out. So it shouldn't be harder to sell, because if you look and you do what you believe is best for the client, and again, everyone's situation is unique, and there are areas where IUL is the right tool, okay? But if you look and do what's best for the client, in our opinion, the whole life product, from the consistency, the lack of volatility, the accountability, the accessibility to the cash value, it's just the right thing to do, right? But if you're going to put an illustration side by side, Johnny Advisor's illustration is going to look a heck of a lot better. And we as consumers are like, I want that. And then they're going to come back and say, hey, we've posted a couple of zeros in here, right? And it still has this average rate of return that's really, really good. I will tell you, I have more policies of those that we have to unwind, that somebody brings the illustration and we look up the actual, and they are so vastly different. Now, again, those are unique situations. I'm sure your client situations that buy them are totally different, and they're all performing very, very well. But the ones that we talk with, man, it is a vast difference. And so at the end of the day, would we rather miss on a couple of these relationships with people that want this and keep the ones that we know and could put our head on our pillow every night that it's going to turn out the way that the insurance company said it was going to turn out? I sleep a lot better that way. And by the way, mind you this, a lot of whole life insurance companies no longer sell whole life and have transitioned to IUL. They're all for-profit companies. So why do they do that? I don't have the answer because I don't sit in their boardrooms. But if you're a for-profit company and you drop one and try to market the other, there's a reason.
Yeah.
Now, I have a statement and a question. So when it comes to risk, what whole life insurance does for us when we talk about our investments is it operates for us as insurance, as a barrier from the risk of what we are investing in, be it real estate, be it whatever it is. When it comes to using an IUL product, that risk starts with the policy itself, where it doesn't. If I want to use those funds in investing in something else, yes, it says that I may have a higher rate of return, but the complexity of it as its own level of risk before I even use the funds. The question I have,
Darius. Keep in mind, let's break risk into two categories.
Okay.
First of all, in either chassis, IUL or whole life, the death benefit is going to pay out, right? As long as you're buying a good company or whoever the case may be, that's the receiving the death benefit is not the risk. Okay. It may vary depending on how the inside values are, but the death benefit is going to be paid out. The risk lies with exactly what you said, is the accessibility to the cash inside the product, right? Or inside the chassis. That's where the risk lies. And you hit on something that I think is critical. If you need return, there are a lot of other places to go get better return. The product or insurance in general is not meant to be your growth vehicle or your growth asset class. To your point, it's meant to be the consistent asset class that can be leveraged to create wealth.
Mhm.
It's very hard to do in a volatile environment, which is the IUL product.
Mhm.
So my question is, with all that being said, who's this for? Like, who's the target audience for a product like this?
There's a lot of unique things that you can do. You know, when you associate collateralizing them and you know, some of the other things that are done and different tools where you need to try to get the growth to pump up, you know, estate planning. There's tools where it is accessible,
Yes.
but for the run of the mill general day-to-day person, if they are looking for a product that is consistent, that is going to be able to provide consistent growth, liquidity and access to cash value, tax-free growth, as long as it's structured properly, and a death benefit payout. These are apples and oranges products. They're not the same.
Yeah.
But it goes back to the issue. One illustrates better. That's the issue.
Mhm.
If you had to illustrate it the way that whole life illustrates something, it'd be very different.
Mhm.
Yeah. It's this whole thing just reminds me of everything that we talk about ownership, right? So Andrew, you had mentioned, Darius was so stuck. He's like, who is this for? Like, who would do this? You know, and we always go back and forth because we have conversations amongst ourselves and we're like, what are we missing? Is there something that we're missing? And we continue to research and read. And every single time we're still like, what are we missing? Because again, people keep coming to us and say, Darius and Carmen, this thing is super sexy. You got to check it out. You got to figure it out. And every time we go back and we're like, I just don't see it. I don't see it yet. But it goes back to, again, this whole part about ownership and everything that we talk about, owning your own lifestyle. If you decide to have a product like this, ownership is on 11, right? You have to know and understand this product like the back of your hand. You have to know and be involved in the market as much as you possibly can so you can understand the activities and how your policy is growing or not, whatever the case may be. So this just takes levels to this. And like you said, I don't necessarily, in my personal opinion, know if this is right for the, like you said, the average person, just because of what we know the market is going to do and what people typically need. And so we do tend to see that this product more with business owners who have very strategic plays that they're trying to accomplish with managing their money and profit and losses and things like that. So it just really depends on what it is that you're trying to do, what your goals are, and to know that there are tools out there for you, but you just really have to understand how they work so that you can make the best decision for yourself.
Now, I did hear that we can earn a higher commission on IULs than whole life, right?
Well, in general, yes, that is the way that they work. They have a very different commission structure or payout structure to the advisor than most whole life products do. Specifically, the ones when you look at the major players, Mass, New York, Northwestern, you know, the participating whole life companies. It's very different. I would break it down like this. You asked a question, Darius. Some people are risk takers, right? And the amount of money that people put into these policies on an annualized basis can be a lot.
Yeah.
And so if you ask me, I'm going to break this down like I was buying a home, because you know, you have your mortgage or whatever you're paying for a home, and you're putting a lot into a life insurance policy. For some people, it can be as much, if not more, than a mortgage.
Totally.
If somebody came to me and said, hey, there's these two like homes, okay? And one home, you're going to buy, let's just say it's $250,000. You buy that house and it's going to grow at a very consistent rate. And we know in 15 years, you're going to be able to sell that home if you want it. And at that point in time, maybe it's worth $325,000. Or you buy the same home, $250,000, and in 15 years, it could be worth $260,000, $280,000, maybe $300,000. Likelihood it gets to the same $325,000, we don't know. You have a 2% chance it could be over $325,000. I'd buy the one that I know where I can sell it for, right? And so that's the thing, is you're putting a significant amount of money in this, but we don't think of it like that because we look at this illustration and we say, oh, it's going to do that. No, it's not. The likelihood it's going to do that is probably not very good. And remember, they call it an illustration for a reason. It's not guaranteed. There's no guarantees in any of these things. They're illustrating a hypothetical situation. And if they can go in and start manipulating the return, well, let's run it at 4%. Let's run it at 5%. Let's run it at 6%. Let's put a couple zeros in here and then a big number, and let's do that. If you can manipulate it that much, that's concerning.
I'm so glad you said that point, because again, to your point, we can't do that with whole life insurance policies.
Nope.
And knowing with the build of an IUL, like you said, you can manipulate it to do whatever it is that you want. So that for me, again, as an agent, is concerning from the most part, because I can't predict the future.
No, no.
I'm glad you brought that point up. We didn't even think to talk about that.
Well, you did say the commissions are higher though.
He keeps bringing it back. Well, Andrew,
that's not why we do it, though.
No.
You got to do what's right for the client.
Yeah, exactly.
If you do what's right for the client day in and day out, the rest of everything works its way out, right?
Amen.
If
Absolutely.
you're doing something because it pays more, that's the wrong angle, in my opinion. I'm not stating. And again, let's be clear. There's a lot of really good advisors out there.
Yeah.
Right. Yeah. There's a lot of them, and there's a place for this product. But it is, in my opinion, it is not as broadly required as it is used.
Mm-hmm.
But some people are gamblers. If you're a gambler and you want to roll the dice on this type of thing, at least if you go into the market, right? At least if you go into the market is what the market is, and it's efficient, and you've got a long track record, and it's not simulated. There's no caps. You get the full and you get the down, right?
Yeah.
And so you get what you get. In this one, IUL in particular, because they're simulating and there's caps and there's zeros and you could get this, but not that. It's so complex. It's just really, really challenging to determine what the outcome is going to be.
Absolutely. Well, any parting words, folks? I think this was enough to give people some meat on the bone to think about. A lot to chew on. Any parting words before we go?
No, it's great to be on with you guys. I always appreciate it. Again, I think everybody's situation's unique. We're not on here to say you should or shouldn't do anything.
Yes.
We're on here to just kind of talk about what we think and what we've seen and our experiences, and your situation may be completely different than what we're talking about. And if it is, it might be the right product for you.
Absolutely.
There you go.
Yeah. So to recap, Wealth Nation, what we've talked about is what is an IUL, why it was created, how it could particularly perform, and who this policy could be for. So if you have any other questions that you want to ask Wealth Nation, ask myself or Andrew or Darius, definitely put it in the comments so that we can make sure we get to your questions and we can continue to help you make informed decisions along the way. Now, if you do decide that you want a whole life insurance policy, go ahead and click on the link below so that we can make sure that the Wealth Nation concierge team, serviced by Prevail, can help ensure that we can accomplish your financial goals. Don't forget to own your own lifestyle.
Or someone else will.